get extremely clear on who should say no quickly, if you could define the non-LP as well as your target LP. Again, like if you're an early stage manager and you're fundraising, let's just say $150 million, this is non-VC. Maybe the larger institutions aren't good targets. Maybe focus on family offices, endowments, foundations, so you can avoid wasted cycles, inconsistent messaging, and credibility. I think the focus beats volume early, and focusing on allocators that makes sense is much better than just trying to hit the home run.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Miguel Silva on the mic. He is an investment manager at CalPERS on the investments team, where he helps lead one of the most important jobs in institutional investing, identifying and backing emerging and diverse managers across private markets. Mike has spent over a decade at CalPERS and more than 20 years in investing overall, spanning real estate, wealth management, and now building programs that help shape the next generation of private market firms. Today we'll dig into how allocators actually underwrite talent, what it takes to scale an emerging manager, and how the institutional playbook is evolving. Thanks for coming on, Miguel.
Well, thank you for having me, Brian.
The audience may not know this, but we're both in the Sacramento region, so we're kind of like neighbors. We could have done this in person.
Yeah, that would have been nice.
I don't have the recording equipment and cameras all set up for that anyway, but to get your origin story.
Sure. Let's see. So I'm originally from San Diego, Portuguese descent. Both my parents immigrated in the early 70s and matriculated in San Diego, went to college at UC Davis, nearby here near Sacramento, and originally thought about going to law school, got involved in public affairs, did some legislative work, worked for the Department of Insurance actually as a press information officer, and decided to get into investments. Started in commercial real estate here in Sacramento. A local broker, Randy Getz, hired me. At that time, it was a 3-year plan to start your career. I worked for Randy for a year, and I thought I learned enough and elected to go out on my own as a broker with Marcus & Millichap. And certainly, that was a difficult task. Because
that'll build character. I worked at Marcus & Millichap in New York for a hot minute when I washed out of Wall Street, when I was like in my quarter life crisis, mid to late 20s mode, like trying to figure out what I want to do with my life. And I remember it's just like 200 phone calls a day, basically.
It's a tough gig, right?
It's a tough one. Yeah.
Because you're trying to get your first deal. So you're trying to convince folks to, have them list their multi-million-dollar property with someone.
Yeah. Here's some 20-something kid. Hey, you want to list this like $15 million property with me? It's like, get out of here, kid.
Yeah. It took 16 months for me.
And that's pretty typical.
Yeah. No,
to get your first deal. Yeah.
But I thought I only had about 2 or 3 more months left in me. So, it was a definitely hard course. But I had a very successful career. Obviously, after that listing, it sold, record prices and everything. The market just started heating up. I was there for about 8 years and I transacted about $150 million worth of transactions. And I quickly realized that I was on the wrong side of the phone. So I actually began some entrepreneurial efforts in raising some capital myself, a couple $1 million, put together 2 groups, both of which I was a managing member alongside partners for a commercial retail strip center in Davis. I knew that area very well, and a medical office building here in Sacramento. So yeah, it was, and of course I purchased those properties in 2006 and 2007. Yeah. So you can imagine 80% of properties purchased in the 2 to 3 year span. I went back to the bank, but I'm very proud to say that my 2 investments did not. Yeah. We were able to, it took a while, we had to hold them for several years. I'd say longer than several years. I think one was 8 and the other one was 10 years, but we ultimately, we cash flowed, made a profit, and I'm very proud of that work. But, what came out of that was, I couldn't ride out the market. After the financial crisis, I just realized it was going to take 4 or 5 years for that commercial real estate market to pick up. I didn't have that And so this opportunity came up at CalPERS. I had a very good friend of mine who worked at CalPERS in the investment office, and he encouraged me to apply. And there were a couple jobs open, and there was a opportunity for an emerging manager position. They were looking for someone who, had some legislative experience, had some public affairs experience, and had experience in public and private markets. And I checked the box on all of those. And I was very lucky. I think this was, almost this opportunity was godsend. And, it kind of rescued me because, 40 years old, trying to start something new, not necessarily the best time to do it either, coming out of the financial crisis. So I've been here at CalPERS for 13 years.
Wow, amazing. And I, when I moved from New York, I lived in Japan and we went to Hawaii to stop, and I got into commercial real estate there as well. It was the fall of 2008. So it was right as the markets were crashing. And so my first year, and it was retail real estate, technically resort retail real estate. So I like mainly restaurant and retail space around the islands at resorts. And yeah, it was brutal that first year. Yeah, great timing. Yeah. I've timed myself so well throughout my career. I graduated college in 2003, a really bad time to graduate. Commercial, like Wall Street, was actually good timing. I was at mortgage-backed securities in the like 2006 and 7 heyday, but then the commercial real estate really bad time.
I'm a Gen X, so I think we've
I'm 1980, so almost the same. Zennial, I guess, is how I'm defined. So back to CalPERS, what is the biggest misconception GPs have about what large allocators like you guys do all day?
I think that most of the managers I don't think they understand that our limited resources, certainly we have a very large investment office at CalPERS, likely the largest.
Yeah. The AUM is trillions of dollars, right? What is the AUM?
Well, not that much.
Okay. Hundreds of billions.
Yeah, hundreds of billions. I think we're 570 billion last time I checked. And we have a very large staff in the investment office, over, I want to say close to 350 people.
Wow, okay.
That includes investment office staff and support. So we certainly have a large staff, but we don't have the resources to review the multitude of opportunities across all of the asset classes.
Yeah, there's something like 3,000 new emerging managers every year, probably shooting you guys decks. And it's just like, I don't even know how to evaluate all this stuff. It's kind of the same problem I have with startups, right? There's 30,000 new startups that get funding every year, pre-Series A funding. And it's just like, how do I even get through all this? Yeah,
it's really a conversation I have with managers all the time. Is I tell them, how many managers do you talk to?
Yeah,
on an annual basis, and how many opportunities, portfolio companies do you talk to, and how many do you fund? And they'll tell me it's pretty much actually it's worse for them. Their ratio is worse than our ratio. Our ratio is certainly at 1% tops.
Yeah.
But I think that one of the biggest misconceptions, at least for emerging managers, is that when, like a large player like CalPERS, that because they have, excess, whether it's 570 billion, because it's such a large AUM, that we have money to provide emerging managers. And it's really the other way around. It's our size almost prohibits us from, being a large player with emerging managers, because obviously we want to invest in larger, more meaningful, or make larger, more meaningful allocations. Otherwise, the due diligence that we would do on a small manager is the exact same due diligence that we would do on a large manager. And so we just don't have the resources to invest with hundreds and hundreds and hundreds of managers.
Right. Yeah. And it doesn't move the needle on a $570 billion AUM.
No,
right?
It doesn't.
Writing little $10, $20 million checks, it's, even if they knock it out of the park and have a 10x fund, it's like, great, cool. I got $100 million back, it's like a rounding error for you guys.
And each of the asset classes still have to deploy, whether it's $6, $7, $8 billion, whatever the number happens to be. They still have a lot of time, they still have to deploy that capital, and doing so in, $25 to $50 million chunks is going to, and applying the same level of due diligence is going to take some time. It makes it very difficult for a large institution like CalPERS to be heavily invested with emerging managers.
So for listeners who don't live in the allocator world like we do, what does an emerging manager mean inside CalPERS, and what does it not mean?
Sure. I would say Well, just strictly definitional, it's first, second, and third institutional fund with no fund size over $2 billion. And that's for the private asset classes. For the public asset classes, it's strictly a AUM threshold of 5 billion. So
Okay, interesting.
we don't have emerging managers or an emerging manager strategy in global equity or global fixed income. So on the public side, we don't have any, most of that is managed internally. And passively, I think, I don't know the exact number, but I would estimate that our global fixed income is, internally or managed over around 95% or more. And our global equity is somewhere around 90% as well.
And when you say institutional fund, that's a really interesting distinction. What does that mean?
Well, that's a great question. I think, for CalPERS, it would, we have a reporting standards here at CalPERS. I would say we're certainly by law, at least on the private side, managers are, there are legal requirements on the reporting side. But, for on the emerging manager side, I would say a manager that has a repeatable, scalable strategy, certainly a team and talent that has depth and experience. And, we're obviously, when we're investing with emerging managers, we're looking for managers with a strategy that makes sense, or there's, portfolio fit for us. The other thing, in terms of operations, there needs to be discipline in the decision-making, the risk management, and the alignment of what I was talking about. Certainly it's harder to forgive sloppiness, in investment judgment or governance. But, for emerging managers, we want them to be gritty and scrappy, and not just in their controls, but we want to make sure they have strong controls, good transparency, and good ethics.
So what does great look like when you're evaluating an emerging manager? And maybe you can give me kind of what are easy passes for those characteristics you described?
Well, I think that, we're looking for, a lot of times, what I'm seeing in the marketplace right now is there's a lot of seeding and staking going on. We announced in 2023 $1 billion platform, 500 million for the GCM Elevate and 500 million for TPG Next. Those are seeding and staking platforms. And I've noticed in the marketplace that those have been popping up. They've been very popular.
Yeah. What does that mean for people listening that don't understand what that is? Yeah.
In this case would be CalPERS provides an allocation in exchange for a stake in either a piece of the firm or the fund, the management of the fund. So they're getting a return. And I would say the marketplace has changed. I think 5 years ago, those were frowned upon by the manager community. But over time, I think managers are more open to those types of partnerships. I think that certainly the difficult climate in fundraising has helped, with that, because getting dollars is difficult. So, those types of partnerships are important, because a lot, GCM Elevate, our GCM team and our TPG Next team, they really help, get managers and make them more institutional ready with regards to, a lot of these managers, they're great investors. These folks have been investing for 20, 25 years. What they haven't done is actually run a firm. So when you're starting a firm, there are all kinds of issues like HR, legal, tech, that you need to be apprised of and hiring, that's certainly a big item. So I think that, our partners do a good job. TPG Next and GCM Elevate do a good job of making sure what managers need to be aware of to run a successful firm. They provide support, and the managers can count on those partners to make sure that they're institutional ready.
When is an emerging manager ready for a program like that versus they're kind of too early?
It's a good question. In those types of programs, I'm seeing, at least from a fund size, it's certainly between, let's just call it 150 million and 750 million. These are non-venture, right?
Okay.
Non-venture, 150 million to 750 million are generally around what I'd say is the sweet spot. But, clearly an articulated strategy, a strong team, again, I'm seeing a lot of spin outs coming out. So we've got, employees coming out of really successful firms or funds trying to execute a strategy. They might be coming out of a larger firm that has become an asset gatherer and is no longer deploying the same, strategy. So they might spin out and redo that same old strategy that worked. So I see that a lot. That would probably be the best way to describe it.
So what is your current mandate at let's call it you got 570 billion of assets, right? What percentage is going to a VC and PE? And of that, what percentage is going to, like, call it emerging managers in VC, which is most of our listeners in our podcast?
Well, I would say, so we have been on the SAA, the strategic asset allocation model, and now we've recently moved to the TPA, the total portfolio approach. This happened in...
I know my listeners do not know what those acronyms are. Maybe you could explain what each of those are and why the move.
Well, the strategic asset allocation is really, think of it, allocations are going to each of the asset classes.
Yeah. There's some percentage, and it's strategic based on your cash flow needs and your liquidity time horizons and things like that.
Correct. Where we've moved to a total portfolio approach where it's really working across all of the asset classes and determining where the best investment is and the best use of the dollar. So rather than
trying to maximize returns, more or less.
Correct.
Risk-adjusted returns.
But in terms of private equity and venture, the first 10 years that I was at CalPERS, the mantra was we were overweight in venture. So we were not investing in venture. Anton Orlich, the managing investment director for private equity, that was one of the significant changes that he made a few years ago, was to get CalPERS reinvested into venture. I think that they established, target of getting to 6 billion, I believe, but that would be over a long period of time. But I wouldn't be able to share with you what the asset classes, allocation to venture is, or what their plan is moving forward in terms of.
Right.
But I do know that we're, the asset class is certainly investing in venture. That includes emerging and non-emerging. But we don't have, at least at the moment, I would say, an emerging manager fund of fund for venture.
What do you mean by that?
So CalPERS invests with emerging managers in 3 different ways. One is the intermediated fund of fund. So CalPERS will find a partner. In the past, in private equity, I'll give you the example, was GCM. The GCM Grosvenor team made our domestic emerging manager funds 1, 2, and 3. Those were 150, 250, and $550 million allocations to those funds. So GCM would then find emerging managers for each of those funds on our behalf. That's a separately managed account, and they would invest on our behalf. And then the second way we invest with emerging managers is also through intermediated, but it would also be seeding and staking. So very different from just making straight commitments and co-investments. Seeding and staking, now we're seeding these managers and we're taking a stake in these managers. So generally, those are, in the domestic emerging manager funds, those were 20, let's just call it 20 to $50 million commitments, $20 to $40 million commitments. Whereas in the seeding and staking, you certainly have to give up, you have to make a larger allocation or a larger commitment to get that stake. So those are between, let's just call it 70 or 50 and $150 million commitments.
Yeah,
and then
pretty large.
And then the third way is without an intermediary. So the asset class makes a direct investment with the emerging manager without an intermediary. Since Anton Orlich has arrived in the last 2.5 years, CalPERS has invested over $6 billion with emerging managers. So Anton, and prior to Anton's arrival, I'm not sure what the number was, but it was, certainly under 500 million in the previous 5 years. So Anton has really Anton and the private equity team, I should say, have really made a significant impact. They see opportunity and outperformance in that middle market. I believe that part of Anton's strategy, I would say just from observing from where I'm at, is he's shifted away from some of the larger funds and moved to the middle market, where certainly there's a larger dispersion of returns there, but a greater opportunity for outperformance. And we've seen that strategy come to fruition because CalPERS private equity performance is doing very, very well, particularly in the last 3, 2, and 1 years.
Yeah, I think there's lots of data on this from Cambridge and Carta and AngelList around, especially in VC. Not private equity as much, I would suppose, but that returns are kind of inversely correlated, but so is dispersion, like you said.
Yeah.
So as you get smaller, you get better returns, but you also get a higher standard deviation around the expected return. But I think if you're running a fund of funds model, and you're investing in dozens of smaller managers, you collapse the standard deviation around the expected return of that kind of segment of the asset class.
For a large institutional player like CalPERS or some of the larger public pension plans, fund of funds can often be viewed in a negative context because
they're just taking an extra 1 in 10 on top of everything.
Correct. There's an additional layer of fees, or what's often referred to as a double layer of fees, and that eats into the performance. But I would say that our domestic emerging manager funds 2 and 3, the 250 and the $550 million allocations, outperformed the private equity policy benchmark and the private equity asset class itself, net of fees. So it was a good example, because certainly there's pushback on these strategies, and usually the pushback has always been, they're riskier, the fund of
less liquid,
riskier, less liquid, difficult to, the manager selection part of this is very difficult. I mean,
it is.
There's, as there's a multitude of opportunities out there, and you have to select the best ones. So, really proud of the private equity team and the work that they've accomplished, and particularly with emerging managers. Now, my role, I certainly work with the private equity team. I co-manage and co-monitor the TPG Next, the GCM Elevate, and the GCM Domestic Emerging Manager Funds 1, 2, and 3. And I provide them with referrals, you can call it, of managers that they might be interested in having a conversation with. But the private equity team is in charge of managing. They certainly are the primary reason for the success in selecting the emerging managers that they've worked with for the last 3.5 years.
Yeah, impressive. So how do you guys balance the tension between institutional quality and early stage scrappiness when you're underwriting a first or second time GP? Maybe they're even on their third fund.
We due diligence the managers the same way. So in that sense,
let's talk about the diligence process. Like, what does that look like at CalPERS?
I'd break it down into five basic categories. Historical performance. Sometimes emerging managers, it's difficult to determine where their performance comes from. So you have to do, again,
got to dig in.
When you're diligent.
Are these cap adjusted markups with safe markups? Are they priced? Does that matter? Like, is it audited? Is it non-audited? I'd imagine, because you guys are a public pension fund, everything has to be audited if you invest.
Yeah, no, certainly. I mean, everything has to be audited, and it's a difficult thing, but we want to, we have to make the extra calls, figure out the performance. Secondly, you have to determine whether the strategy is scalable and repeatable, because if it's not, if they're going to stay small, right? Or if they can't.
You don't want to invest in a manager they're at $100 million fund and they're just going to stay there forever. And you're like, well, we want to write a $10 or $20 million check now, but in your next fund, we want to write a bigger check. And the next fund after that, we want to write a bigger check. So you want to see managers growing from 100 million to $1 billion even, or more.
Oh yeah, absolutely. So we want to see managers being able to grow and take be able to accept a sizable check. But so performance is one, portfolio fit is another, I would say.
Right, because sometimes you're looking at a manager and you're like, I like your performance. I like you. I see that you're going to scale, but we are overweight in this particular segment of the VCPE private market. We're just over allocated on your strategy. Like, we already have a cybersecurity fund or whatever it is.
So that's really important. Governance and alignment is also very important.
Let's dig into that. What is governance and alignment?
Well, I think, we're a public pension plan, right? We certainly have stakeholders that we have to answer to, whether that's the legislature or our beneficiaries, so that there are, certainly managers, can't be breaking the law when it comes to labor. And labor is an important topic for CalPERS and other public pension plans. So private equity managers have to, there's a responsible contracting policy that managers have to adhere to. And we want to make sure that workers are protected, right? So that these profits, aren't putting workers at risk.
Yeah. Yeah. You're not making things worse for the state and society at writ large. What else? What's the other bucket that we're missing?
So we've got performance, portfolio fit, and then strategy. I think some sort of deep sector experience with demonstrated success, a clearly articulated investment strategy that's going to be adhered to, and that thesis needs to be repeatable and scalable. I think that's an important part. So those are really, in terms of alignment, we want to make sure the teams have good depth in them, that, that there's succession planning in place, those sorts of things.
Yeah, that's great. What are some of the top signals that you guys look for to predict whether a GP can build a durable firm, not just another fund? Yeah. So what are some of the signals that you look for in a firm, a GP you're evaluating, whether or not they can actually build a durable firm?
If we go back to the other question, I feel like I could have answered that other question.
Yeah.
It was basically, what are you looking for?
The 5 buckets.
Doing the due diligence on a manager. So we'll start over on that. Do you mind?
Yeah, let's do it.
So I'd say performance, again, how returns are generated and what their performance is relative to appropriate benchmarks. Team and talent. We want to make sure that there's succession planning in place and that there's no key person risk, and the decision-making dynamics and depth goes beyond the founders. The third bucket would be strategy and value creation. So again, clearly articulated, differentiated, and repeatable and scalable strategy. The fourth would be asset allocation and portfolio fit. No managers like evaluated in isolation. So we want to assess how the strategy fits within the CalPERS broader portfolio and the private equity portfolio. And then the last would be alignment of interest, governance, and transparency, fee structures, governance rights, reporting quality, and overall transparency. We want to make sure that it's a durable investment firm.
Right. Yeah. So, and that kind of feeds into the next question, which what are some of the signals to predict whether you can build a durable firm versus just a one-hit fund? And you just kind of cover the 5 buckets. Are there any kind of automatic no's that come to mind across those 5 buckets when you look? Like, oh, I've seen this one before. This is pretty much an easy no.
Well, I think, you see a lot of the same types of strategies, right, that out there in the marketplace. I don't want to say that there's any automatic no's, but I certainly, having conversations, I would say that I probably have had the most conversations with managers than anyone at CalPERS. Now, when I say that, I'm saying 15 to 30-minute conversations, right?
Yeah. Like over and over again, week after week, day after day for 13 years. That's a lot of conversations.
Correct. I've probably talked to, I don't know, anywhere between 1,000 and 2,000 managers.
Yeah, at least.
So I would say that I've I can thin slice it and understand when a manager's not quite, I wouldn't say not institutional quality, but maybe not at the CalPERS level. So that would probably be, I don't know how I come to that quick thin slice determination, but
it's exactly the same problem I have when people are like, how do you pick a startup? It's like describing cause I'll meet, I don't know, I probably meet 1,000 founders a year. So I'm like 6,000 founders in, invested in 300 of them. Plus there's all the no's of reviewing a deck and not meeting people at all. And then people will say, hey, how do you make a decision to invest? Well, it's like probably 100 different things. And, it's like the movie Beautiful Mind. You're just like, there's 100 different things floating around here. And I'm kind of connecting all the dots, and it's hard to communicate that hunch,
Yeah.
You try to build a framework around it, but yeah.
Hunch is a really good way to describe it. You just get a certain hunch for a manager or their strategy. It just sounds, for whatever reason, it resonates. And that, that's just with me. And then I have to send that over to whether it's one of our partners or it's the asset class for them to take a deeper look. But that's part of my role is you could call it screening and then passing it on.
Yeah. How do you think about specialization versus generalists in private markets right now, especially as information gets cheaper and capital gets more abundant?
I would say it has to be deep, not cosmetic, rooted in access, not branding. I think the best managers are specialists, a strong logic, not just tourists going from theme to theme, whether it's AI or blockchain or Bitcoin. I think that's what I see that a lot of theme to theme to theme. Or at least I have.
It's like, well, last time you pitched me, you were a crypto fund, and now you're an AI fund. Yeah. This is why I didn't do an AI fund, because I led AI at Amazon. I built a bunch of AI, right?
Oh, really?
And there was this poll for my LPs to do AI, make Team Ignite an AI focused firm. AI is a ton of what we do, of course, because of my background. But I kind of knew as an investor, I wanted to kind of focused just broadly at the pre-seed and seed, because I felt like if I widen my aperture to almost anything except what I don't know, which is like biotech, that I could have better returns in that asset class, in that stage. And if I would have done an AI focused fund, I'd be setting myself. It's like having an internet focused fund in the '90s. What am I going to do in 10 years? Oh, I'm a mobile focused fund now. I'm a cloud focused fund now. Yeah. So that was kind of my thinking around it.
It's pretty, this AI revolution, being able to be part of it is really interesting. And
Yeah.
what happens next? And what happens next could be tomorrow. Like it's coming
Yeah.
so fast and so quick. It's very difficult to anticipate.
Well, and we're kind of living through the singularity, if you believe that. It's kind of techno optimist hype, but it's kind of hard to predict as we take AGI and kind of deploy it around our economy and our organizations, like what work looks like after that. When AGI is 150, 175 IQ, and you can kind of talk to it like a human being and say, "Hey, can you go do this?" And it's going to be a weird sci-fi kind of world, like Star Trek, in the next like 5 or 10 years.
I'm just glad that I'm here to experience it and see it.
Yeah, me too. It's like the best time to be alive.
Yep.
Back to Elevate, GCM Elevate and TPG Next. What's the difference between evaluating managers for those, two buckets versus a direct commitment?
I would say, the GCM team is certainly, and the TPG Next team, they're evaluating these managers on subsequent success, right? They have to put capital aside for the next fund. They have to look at these managers. They're certainly trying to pick the very best managers. But I would say, we're underwriting the firm's ability to absorb support, feedback, the willingness to partner, not just raise capital, long-term economics and alignment. I'd say, direct commitments are more binary. The platforms, the Next and GCM Elevate platforms are more about building capability over a long period of time with the expectation that, the manager today looks very different in 5 years.
Yeah, they're building an enduring venture capital or private equity firm.
Correct. And, what's interesting on the seeding and staking versus the fund of funds with just commitments and co-investments is the seeding and staking. We are partnering with these managers at the earliest part or the earliest stage of the firm life cycle. So it's very much like venture, right? So you're taking a chance on these managers. Even the returns are a bit delayed because some of these managers are just at the earliest stages of building their firms. So we're hopeful that the manager looks very different in 5 years in a positive way.
Yeah. So emerging managers are often told just to get your first institutional anchor. No big deal, right? But getting that first one's brutal. What do you think emerging managers should do differently to earn trust faster with institutional LPs?
I think you have to be very honest about the gaps. I try to ask, what lessons have you learned? I try to really ask the question where they can share some of the struggles just to hear their response. You have to show some sort of like learning velocity, and say, yes, we made the mistake here, but here's what we've done. These are the steps we've taken to correct this. And let me give you a case study on how we've learned from this and profited from it. So you have to demonstrate some sort of alignment before asking for capital. Institutional LPs are underwriting character under pressure. We want to know how managers react during difficult times. The managers who get anchors early are usually the ones who don't pretend to be bigger than they are.
That's the interesting phrase, bigger than they are, pretending to be bigger than they are. It's something I struggle with as a solo GP, right? Is scaling. I struggle like, okay, I definitely don't want to bring on a partner. That's just like out of the question. I don't want to have to explain myself to another GP, decisions I make. But I definitely do need to bring on principals, right? I need to bring on some principal level people to do the deal screening, portfolio management, and all the operations, the CFO stuff. How do you guys think about solo managers like myself versus teams? Do you guys back solo GPs?
I mean, I think in the emerging manager space, we do, just because particularly in the smaller, when we're making the smaller allocations. So part of the domestic emerging manager funds, there were some solo GPs in there, but, generally as it relates to when you're making larger allocations, 50 million plus, there needs
you're going to want a team in place. Yeah.
Correct.
Yeah. 50 million on a $500 million fund. That's not going to be a solo GP anymore, right? There's going to be a firm there.
Correct.
With partners and partners in different asset classes and in the fund. And
but there are, for particularly in VC, you see fund of funds that are making, $5 to $10 million investments. Those are happening at this level all the time. And at the moment, we don't have a fund of fund structure or a fund of fund program for VCs and private equity, but we're advocating for one, and I'm hopeful we'll get one in the future.
Yeah. So what's changing now? I mean, obviously the emerging manager market got harder in recent years with fundraising. What's structurally changing and what's cyclical noise from your perspective?
Well, structurally, I'd say capital is concentrating. Obviously, we did a look back, and larger funds and platforms and established managers are absorbing more allocation attention. So that makes it more difficult for first-time managers. There's also higher expectations around governance, reporting, operational readiness. And, those aren't going away, at least for, institutions like CalPERS. Cyclically, risk appetite tightens and loosens. Right now, there's slower exits. So the denominator effect is suppressing new commitments, but that's going, that should ease. And I would say the structural shift toward fewer, more deliberate relationships, is probably going to be the model.
Yeah. Where do you see the biggest white space in private markets for new managers now?
That's difficult to say. I can't answer that one.
That is a tough question. How do you, as soon as I said it, I was like, that's going to be a tough one.
Well, if I knew,
you'd go out and be a manager.
I would leave CalPERS.
Yeah, exactly.
Miguel's
a new GP.
Yeah, try it again.
Yeah, exactly. How are you guys using technology and AI in your sourcing, benchmarking, portfolio construction, diligence, all that stuff? I mean, as a GP, it's definitely accelerating everything we do. I'd love to hear from your perspective as a LP.
Well, that's a great question. We're certainly using AI at CalPERS. We have our own AI model named Persi, but how we've integrated it for manager, diligence and selection, I don't know the answer, but I would imagine that there's work going on now as it relates to whether it's sourcing signals, benchmarking, or the portfolio diagnostics. But those are just top of mind. I don't, it's still very early. And I think asset classes are still trying to better understand how to leverage that resource.
Yeah. Any final thoughts or things you want to bring up before we do our wrap up questions?
No. Go ahead. I'm ready to go.
Let's do it. So what is one allocator behavior you wish every GP understood and what changes when they do?
Allocator ready behavior.
Allocator behavior.
I would say, just that, it takes a long time for CalPERS. We're reviewing a lot of opportunities. There's resource constraints, there's budget constraints. And I think that managers just need to understand that just because we're large, it doesn't mean we can just allocate to everyone. And I'd say that would be my answer to that.
Yeah. What's the most common unforced error you see from first-time managers during fundraising?
This is going to sound kind of funny. I would say I hear this statement a lot. We would love to be anchored by CalPERS, or we would love a commitment from CalPERS. And I talk like that too, but I think that managers forget, to share the benefits, first do some research, try to better understand what our needs are. Is this a portfolio fit? If so, why? Explain to me why CalPERS should invest in this fund or with your firm, why we are looking at it. That makes it a lot easier than us investigating the manager. So the manager
it comes in customized to you. It's like, here's all the benefits and why it's a fit. I've already done the research because a lot of stuff for CalPERS is out there. I mean, you guys are public, right? So you have to publish your mandates and all that, right?
All of our investment committee meetings are online on a YouTube channel. You can watch them live. You can watch them recorded later. Certainly all the materials are posted on our website as well. Now, I know that's really hard for the managers. The managers are looking at it like, this fundraising climate is incredibly difficult. I've got to reach out to, hundreds and hundreds of allocators. I don't have the time to, look at each.
I probably, for fund two, that was my first real, 10-year fund. I I got thousands of no's on that one.
Yeah.
Thousands to close 40 or 50 LPs, thousands of no's. What's your crystal ball for 2026? Like, I feel like we have a lot of IPOs on the horizon. We're going to get some liquidity. It feels like we got a little bit of wind in back in our sails now than we did in the prior 2 or 3 years.
Yeah. It's hard for me to say because, I'm operating in somewhat of a bubble at CalPERS, right? My days consist of 2 or 3 manager calls a day, collaborating with the asset classes and, real estate, private debt, and private equity. So I'm working across, I'm more of a generalist working across those asset classes. So it's really difficult for me to prognosticate on, the marketplace.
Well, I guess you could probably look at historical TVPI versus DPI rates in the asset class and kind of say, like, we have this overhang of like lots of TVPI, but not a lot of DPI, right? And we're hoping, in 26 and definitely into 27, that those 2 numbers start to converge a little bit in a way that they've kind of diverged, especially in the last few years. That's what I'm hoping I'm hitting the market at the right time. What's a thing an emerging GP can do in the first 90 days of fundraising that dramatically improves their odds?
I would say get extremely clear on who should say no quickly. If you could define the non-LP as well as your target LP, again, like if you're an early stage manager and you're fundraising, let's just say $150 million, this is non-VC, maybe the larger institutions aren't good targets. Maybe focus on family offices, endowments, foundations, so you can avoid wasted cycles, inconsistent messaging, and credibility. I think the focus beats volume early, and focusing on allocators that make sense is much better than just trying to hit the home run, with CalPERS and other large institutions.
Yeah. What's your strongest view about venture capital, private equity that you think most people will disagree with?
I think scale is a headwind, not an advantage. I mean, we talk about that you need to be repeatable and scalable, but as funds get too large, I think the alpha begins to compress a bit. So I would say the next, maybe in the next 10 years or so, we'll reward managers who protect capacity, even at the expense of short-term growth.
Don't get too big. Right?
Don't get too big.
Yeah.
We want you to be scalable.
Yeah.
I think, between $1 billion and $2 billion makes a lot of sense, but if you get too big.
Yeah. Yeah. The whole venture capital is like 200 billion a year. Right. So you can't get, much bigger, like maybe than Andreessen or something like that. What do you think is a private market skill most undervalued today between like sourcing, underwriting, portfolio support, fundraising?
I think fundraising is very underrated.
Yeah. It's
I think that I meet a lot of talented managers. You clearly, strong skill sets across the board, but the fundraising is always the weakest component that I see when I'm meeting with when I say meeting, like I'm meeting managers for the first time, whether it's at a conference or not, I see that skill set needing to be bolstered a bit.
Yeah. Last question. So looking out long-term, 5 or 10 years, what are you excited about? And we talked about AI and stuff, but
I'm excited for the emerging manager, let's just call it the industry or the marketplace. I think that there's been these headwinds against emerging managers for so long. I think that the opportunity is with emerging managers, right? Particularly in the lower and middle markets, there's an opportunity for outperformance. And I think that institutions, large and small, are recognizing that opportunity. And that's, in private equity, venture, private debt, real estate. I think that lower middle market and middle market is offering opportunities, good exits. So I'm really excited for the emerging manager space and what's next in the next 10 years.
Awesome. Well, Miguel, thanks so much for coming on. I learned a ton. I really appreciate it.
Hey, thank you so much, Brian. Appreciate it.